Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook. We are at the beginning of a new week. It's Monday, 15th of October, 2012. The highlights for the beginning of the week are as follows. The euro starts the week at the back foot following last Friday's upside rejection at just on approach to 130 barrier and fresh slide down to 129 with some recovery seen at the beginning of European session, still seeing the downside a bit more vulnerable. Sterling is approximately at the similar position as recovery failed at on approach to 161 and still keeping more pressure towards recent supports at 160.00 and 159.75. Dollar remains well supported against Japanese yen, attempting through the recent range top at 78.60, keeping focus on the upside in the near term towards 78.80, 79.00 to possibly open way for key barriers 79.21 and 79.30, which is 200 days moving average. While dollar Swiss is holding a near term a positive tone of 93.04 last Friday's low on recovery, but still lack of momentum sees no much prospect towards the upside, as a larger picture remains firmly bearish on its descent from 99.70 peak of I do apologize, the peak of 99.70 peak of 24th of July 2012, with the recent recovery consolidative, I would say, phase of 92.37 seen well capped around the 94 zone, and any failure to break higher would signal double top and further extension lower. Oil remains under pressure on the increased worries about further demand, despite some positive data that came from China on the inflation, signaling the possible further monetary easing of Chinese central bank, while gold is seen as the top loser of last week, dipping below important supports at 79.55 and now turning focus down towards the recent range low at 17.36. As said, quite weak outlook for the in the near term structure of yellow metal sees now more and more opportunities for a stronger corrective action, as a break below that recent range floor would be signal for this the corrective action of the broader down uptrend from latest up leg, basically from 1590. This is the low of 1590 is the low of 15th of August 2012, and so far the yellow metal has been congested between 1750, 1736 on the downside, and of course posted fresh high at 1795, fresh yearly high, but failed to sustain gains and stays short of important and psychological 1800 barriers. As said, China inflation eases. I do apologize. I made a mistake. The policy, the release of Chinese CPI data basically are easing the fears of further easing of the monetary policy. Banning inflation that was released last night for during the night for September showed China has scope to ease policy, even as evidence mounts that earlier pro-growth measures are gaining traction and reducing pressure on policy makers to act as once a decade the leadership transition approaches, as signs that lending is finally perking up. The approaching end to the destocking cycle and stable employment could allow a policymaker to argue that steps taken earlier this year to support the economy in the face of stronger global headwinds have worked. Subdued the consumer prices, meanwhile, have left plenty of space for them to act to spur faster growth in the winter, after a new generation of leaders take over the ruling Chinese Communist Party. From Spain, that is basically the focus of Eurozone. The Spain could ask for financial aid from the Eurozone next month, and if it does, the request would likely be dealt with alongside the revised loan program for Greece and the bailout for Cyprus in one big package. Eurozone officials said last Friday the Spanish government is considering the conditions of such a rescue package and has said it would take a decision only once it has more clarity on the conditions and the scope of the aid. Spain now replaces Greece, Ireland and Portugal as the main focus in the Eurozone debt crisis earlier this year after it's crippled banks and highly indebted regions, a second recession in the 3 years and soaring debt unnerved investors. Since then, the country's borrowing costs have reached levels deemed unsustainable in the long run, raising the prospect of a second aid program for Madrid following the 100 billion euro lifeline it obtained for its banks in June. So these are basically the highlights that are the Spain remains, as we said, the highlight in the current European situation, and we'll see how it will be. Of course, the Spanish government is expecting, waiting basically for the elections on 21st of October, and then they will be acting. Before these dates, I don't see anything significant to happen regarding the Spanish request for the bailout. Of course, from other side, Germany is still opposing, as the main European paymaster, is still opposing any bailout for Spain, saying that they can handle the situation on their own without help from outside. But it seems that most likely scenario will be the bailout for Spain, as Greece is awaiting its next tranche that has already been delayed due to Greek government not fulfilling all the obligations that they accepted with the bailout program, and now Cyprus is in the heavy negotiations with the Troika. So most likely, as I said, one big package may come for all three countries, give them some money to avoid the further destruction and the further deepening of the crisis in the Eurozone. From today's calendar, we're going to take a look now. Okay, you can see it. Now, as said, Chinese inflation for September came out as expected, 1.9% compared to 2% of month of August, giving some more positive tone into this, while PPI dipped further, minus 3.6% compared to minus 3.5% in August and minus 3.4% forecast, so well below the forecast. Japanese industrial production also dipped significantly, minus 1.6 is the release compared to minus 1.3 forecast, as well as previous release of month of July. As PPI from Switzerland is already out, unfortunately we don't have the update, but I will provide you with the on a monthly basis. 0.3% is the release as forecasted, compared to 0.5% in the month of August, while a yearly release comes at again 0.3 in September versus the minus 0.1 in the previous month. And that will be all for today, Monday, from European side, Far Eastern European. The America starts at 12:30 with the Empire State Manufacturing Index for October. Slight improvement is seen on the negative, still negative reading of the previous month, minus 10.4 with forecast minus 4.6. U.S. retail sales at the same time expected to dip to 0.7% compared to 0.9% in August, while core retail sales again are forecasted at 0.7% compared to 0.8% in the month of August. U.S. business inventories are due at 1,400 GMT, again lower than the previous release. Is the forecast. 0.4% is today's consensus for the August release compared to 0.8% release of month of July. Canadian Bank of Canada Business Outlook Survey is due at 14:30, and then the Governor Carney is going to have a speech at 19:20 GMT, so in the late afternoon. From the markets, we are going to take a look at our technicals now and see the latest movements and see what we can expect in the coming hours. As said, the euro-dollar dipped again down to to the levels close to 129.00 following last Friday's rejection at 129.90. Still in descending mode of 131.70 and the lower top at 130.70, with the 130 seen as a psychological barrier, and the 130.30 is the tentative bear trend line drawn of 131.70 through 130.70, and basically holding below these levels still keeps the downside vulnerable, as the indicators on the near term are still rather negative. Lack of trend currently shown on the 4-hour ADX index, and also the no trend in the daily, as the pair is basically entrenched between 128 and 130.00 consolidation following a strong rally from 120.42 in the end of July low that peaked at 131.70, and finally the pair found good support at 128 zone, where the 200 days moving average still holds the downside, but lack of strength and lack of bullish momentum is evident, making the pair so far unable to clear 130.00 and the more up 130.70. This is the lower top. Break above initial 130.00 and 130.30 is required to open way towards the upper range boundary at 130.70, and that will turn more focus towards the upside, and basically would signal higher low at 128 zone for possible return back towards 131.70 peak of 17th of September, and signal resumption of the uptrend from 120.42. On the near term, still we have a sort of congestion above 128, as also descending tops from 131.70, 130.70, and the latest 129.90 still see more risk towards the downside. As at break above 130.00 and 130.30 is to improve the near-term structure. Conversely, loss of this morning's low at 128.90 would turn focus again towards the lower targets. 128.25 is the low of last Thursday, as well as 200 days moving average, and then the key low is 128.02 1st of October 2012 low. We're talking about this higher base here. Break of these levels would be quite risky, as that will allow for a stronger corrective action of the 120.42 to 131.70 rally, and the open way for a correction down towards initially 127.40, which is 38.2% Fibonacci retracement. The sterling is still in the downtrend, as shown on the 4-hour chart, from 163.08 peak of 29th of September 2012, with a series of lower tops defining the downtrend, as a base so far was found at 159.70, and the quick recovery attempt. This is the low of last week, so far being capped on approach to 161.00, next psychological barrier. That also marks a 50% retracement of the latest downleg from 162.16 down to 159.75. Currently bounce seen of the 160.25. These are the lows of last Friday and this morning, still holding above psychological 160 support, with this slight improvement seen on the 4-hour chart. Still seeing some potential for a stronger recovery. Hourly studies are still in the negative territory, as the pair now attempts through 10 days moving average, and above this we have 160.60 20 days one. Basically we need to see the break above 161 in order to resume the near-term recovery of 159.75 and avert immediate downside risk. As at break above 161 and regain of minimum 161.24, that makes 61.8% Fibonacci retracement, and then trendline resistance approximately at 161.90 will turn again focus towards the upper barriers 162 and 162.16. Regain of the later is basically required to signal bottom at 159.75 and turn more focus towards the upside. Conversely, loss of supports at 160.20 zone and 160.00, and more important 159.75 will again risk stronger corrective action of 152.67 to 163.08 ascend, and they open next important quite strong support at 159 zone. We have the previous peak of 23rd of August. It marks also 38.2% Fibonacci retracement of the entire rally, and also it marks the top of the daily Ichimoku cloud. So quite a strong recovery seen opening, quite strong support seen opening on a break below 160, 159.75. As said, on the upside, the immediate barrier at 161.00 needs to be cleared, along with 161.24 to signal resumption of the near-term recovery of 159.74. Otherwise, we still see increased risk towards the downside, as the pair remains still in the downtrend of 163.08. The dollar yen, as said, is improving the current, the near-term tone following a bounce of 78 base and the break above near-term congestion top at 78.58, with the so far the high so far seen at 78.65 ahead of 78.75-80 zone. These are the resistances. Previous peak at 78.86. Also, we have the 78.72 90 days moving average on the daily chart. Daily Ichimoku cloud floor at 78.67, that is now under attack. Break of these levels is set to open 79.00. That marks psychological barrier, and then to open 79.21. This is the previous high of 19th of September, and of course the 200 days moving average currently at 79.36. So basically we have a cluster of barriers en route towards 79.21, 36, 78, 80, 79.00, break of which is required to open the upper barriers, and above these levels is to signal stronger recovery. Basing attempt then will be seen on 77 zone, with the break above 78.36 to open possibly 80.00 as the next psychological barrier. On the downside, recent range floor at 78.27 now offers initial support, and of course break below here would immediately turn the focus down towards 78.00, 77.94, and weaken the structure. So far the hourly structure remains positive. All the indicators are up and above their midlines, with the price holding above the moving averages, seeing potential, more potential towards the upside. A similar situation on the 4-hour chart, as 20 days exponential moving average so far maintains the current positive tone, with indicators again all pointing higher, and seeing a potential for test of 79 and probably to expand above these levels. 79.21 and 79.36 will be our next near-term targets. Dollar Swiss near-term action remains well limited and capped at 94 zone, whereas the 200 days moving average currently at 93.34, with the brief attempts higher being limited at 94.36 and 94.30, as the recent rejection of at 94.30 seen last week has triggered dip down to 93.04, basically testing the psychological support ahead of important low at 92.73. This is the low of 5th of October 2012. Subsequent bounce higher of 93.04 has been capped at 93.69. This is also equivalent to Fibonacci's 50% retracement of the down move from 94.30 to 93.04 with the fresh weakness seen this morning. Again, shifting focus towards the downside. Immediate support is at 93.23 ahead of 93 level, and then 92.73, loss of which is again expected to turn more focus towards the recent range. These recent lows at 92. The recent low at 92.37, I do apologize, low of 14th of September 2012. This will also risk double top pattern at shown on the daily chart at 94.30 zone with the break below 92.73 seen as confirmation for a test of 92.37. Conversely, any break above 94.00 requires also clearance of 94.30-36 peaks in order to resume the near-term recovery of 92.37, as the pair remains, the price action remains capped by a bear trend line of 99.70. This will be immediate barrier, currently standing at 93.81. As said, the gains were so far capped at 93.70, so just under the trend line resistance, and the immediate support seen at 93.04. And gold, we have to take a good look at gold, as currently signals are quite negative following the break below narrower range floor, that is 93.55, now aiming towards 17.55, I do apologize, aiming towards 17.36, low of 26th of September. Descending studies and loss of momentum on the daily chart sees a serious threat towards the downside, as Ichimoku studies on 4-hour chart have turned firmly bearish, moving below the cloud floor, and also the moving averages are above the price, so the near-term signal is still towards the downside. As said, the yellow metal broke the near-term trendline support of 17.36 through 17.56 and at 17.59. Price is currently below the 20 and 55 days moving average, and all indicators in the negative territory. More focus seen towards the downside. On the hourly, overextended conditions shown as overstretched MACD, and the RSI currently emerging out of the oversold zone. I see potential for some corrective action, and not much to be expected unless we see the break above 17.73-74. These are the recent peaks. Otherwise, risk of a lower top exists with a good barrier seen at 17.53. This is previous range floor. 38.2% retracement of the latest downline from 1773 to 1741, reinforced by descending 20 days exponential moving average, and basically quite a good barrier seen, ideal reversal somewhere around this zone. As said, the only break above 17.75 zone would improve the current structure. Otherwise, increased risk towards 17.36 that will trigger a stronger corrective action of the latest upleg from 15.90 to 17.95 is still on the table, as break below 17.36 is expected to open Fibonacci support 38.2% at 17.17, and then we have 17.00 as a round figure and psychological support, reinforced by 55 days a moving average, and 50% retracement at 16.92 seen on a break below 17.36 range floor. And finally, the crude oil still lacking momentum to clear the important congestion top at 99.30, 99.80 zone, with the recent surge up to 93.60, failing to regain 93.80, 94 barriers and subsequent easing lower now, slightly holding below the near-term range floor at 91. We've seen the extension down to 90.86, weakening structure on the 4-hour chart as the oil price is losing momentum at this point. Still sees risk towards the downside, with the hourly structure being quite negative at this point. Recent bounce sees some indicators pointing higher still. Break above 93 and then 93.60 seen as a minimum requirement in order to shift the focus again towards the upside. As 93.80, 94, 94.20 are the levels seen on a break in order to improve the structure and confirm the bottom at 87.69. So far on the daily chart, the studies are still rather negative as a part of the larger down move from 100.72, along with the increased fears that I mentioned from the beginning about lower demand for the crude oil, as also the U.S. International Energy Agency last week cut its demand growth forecast for this year, still keeps more pressure towards the downside. I would say break below recent low at 90.86 and 90.47 that marks 90 days moving average will again then focus towards the lows at 89 and then 87.69. Conversely, of course, break above 93.60, 93.80, 94 and 94.20 will improve the near-term structure and probably shift the near-term focus again towards the upside. That was all for today. I would like to thank you all for being with us, and please, your questions now. If you have any questions, you can submit them now. It seems no questions at the beginning of the week. In any case, thanks for being with us. We expect you next on our next session tomorrow morning at the same time as 7 GMT, 9 Central European Time, and 10 o'clock local Cyprus time. Until then, wish you a nice first day of the week, and of course, very successful and profitable trading. Good luck.